Now, the headlines may be saying slow down, but investor surveys and deal chatter say something else, that it's actually go time for multifamily. Now, the problem is mixed signals can breed hesitation. So, when you're waiting for perfect clarity, it can often mean you're missing the best opportunities. So, in this episode, you will learn what's actually improving. So, access to capital, buyer depth, where fundamentals are holding, which is in core markets, and the concrete moves we're making in quarter one and quarter two of 2026. Now, signal number one. So the Burns and CRE Daily Fear and Greed Index just came out. Now, this is a document or a sort of survey that is gauging the sentiment and measuring how optimistic and pessimistic multifamily investors and lenders feel about the apartment market where it sits today. So it aggregates survey data, market indicators such as capital availability, pricing expectations, deal flow, and borrowing conditions to help determine whether market participants are acting out of fear or out of greed. And so what's happened is for the first time in a few years, we've actually gotten into greed territory. In other words, more investors and lenders are reporting it's time to lean in to multifamily. So more availability of capital, potentially stronger deal flow. We're going to get into that a little bit later in this episode because there are still some blockers out there that will limit deal flow. But once again, we'll dive into that a little bit more. So bottom line is that we're starting to see a more optimistic lens in the multifamily space. Now, it's important to keep in mind that, as Warren Buffett said, when everybody's greedy, get scared. When everybody's scared, get greedy. And I would say right now we're actually in that moment where a lot of people are still scared. There's still a lot of challenges that are out there in the marketplace, particularly for operators that bought at the peak of the market with floating rate debt. So we're seeing still a lot of distressed deals. And by distress, what I mean is deals that are either at or coming up on maturity that are not able to cash flow and sustain. So we're seeing the lenders still in that extend and pretend mode. And by that, what we mean is basically extending out the loan or reforecasting the loan and sort of pretending like everything's okay. Now, there is some history around that, why we're seeing more of that this cycle versus foreclosures, which we've seen in the past. And the bottom line is you actually look at the Great Recession is a great example where the banks move very quickly to foreclose when operators were not current on their loan or coming up on a maturity. So less likely to reforecast or refinance. And what ended up happening is so many of those properties sold to these large institutional private equity funds, and a few years later sold for massive profits. So the banks have sort of learned from that and decided to take a more patient approach. And as long as the deal, for example, if the operator has capital in the deal, is willing to inject more capital into the deal, and are doing everything they can to effectively manage that property, the lender's likely to work with them more so than maybe say in the past. So that is stifling deal flow. We started this business in 23, and since 23, we've been hearing about this wave of foreclosures that's coming, and it just hasn't materialized for those reasons I just mentioned. So the takeaway here is, prepare to move while others are still processing, right? Make sure you have a strong business plan and you're targeting strong assets in core markets and you likely won't miss. Now, it goes back to that business plan has to be strong and you have to have a strong thesis for what's going on. So in terms of market selection, right? We say core markets, but we're not really talking about the top 10 markets, although we do look in metro Atlanta. Sometimes these secondary and tertiary markets, for example, we're looking at a deal right now in Melbourne, Florida, where there has been 7% population growth in a 3-mile radius around this asset in the last 5 years and projecting another 8% population growth in the future. It's a market that's been largely impacted positively by the privatization of the space industry in the United States. So many high paying, tech driven jobs related to the space and defense industry are growing in that area amongst other manufacturing jobs. So it's not always the, New York City and Los Angeles, right? It's sometimes these secondary and tertiary markets, Charleston being a prime example where we've had a lot of success. Now, signal number two, basically, it's go time. And that's what I would tell any investor that's considering investing. Now, John Chang, who's the Chief Intelligence and Analytics Officer at Marcus and Millichap, was just quoted in Globe Street. And basically his quote was, first, investment activity in general appears to be gathering momentum. Investors have told me they have capital that is ready to deploy and they're anxious to put it to work. So we're hearing a lot of those signals coming from the bigger institutional players, the family office players. And when they start, getting back in the game, it's time for retail investors to really start paying attention. So bottom line is enthusiasm is continuing to grow for retail investors, institutional investors and family offices who have largely sat on the sidelines the last few years are getting back in the game. Now, there are still some concerns out there, and this goes back to you have to be really thoughtful about the markets you choose to invest in because we are starting to see stalling job growth in the United States. Manufacturing jobs have started to pull back. We've also seen just a general rise in unemployment claims, first time unemployment claims. So that's sort of a leading indicator. And a lot of job hunters are saying that it's harder and harder to find opportunities. So that softening job market is definitely something to watch. And that goes back to why you have to be very thoughtful about the markets you choose to invest in, where there are jobs coming into that area. We're seeing a lot of that more so in red states. I live in Georgia. Our Governor Brian Kemp has done a great job attracting investment. We're actually also looking at a deal in a market in Georgia called Augusta, Georgia, that has seen over $1 billion in investments in new businesses over the past few years, manufacturing and high paying technology jobs. So, looking for those key markets that have that population growth and that job diversity and growing job base are the markets we will choose. So being very thoughtful, once again, not to overuse that word, but that is the key critical factor here. You can't just buy any deal in any market and expect it to go well. It's got to be in a great area with great dynamics in terms of job growth, population growth, and affordability. So, bottom line is we're going to expect more competitive bidding on those quality day one cash flowing assets. We're already seeing it right now. A couple of deals we've looked at, we've communicated to the broker, we like this deal. We'd like to go ahead and submit our LOI. And they're saying, look, we're running a full process. We've got tons of interested buyers. So the key factor here is to make sure that you don't get too ahead of your skis a little bit and outbid just in an effort to win the deal. So it's still all about having that disciplined approach to the kind of assets we're buying and the price we're willing to pay for those assets. Now, signal number three, core markets are cushioning the slowdown. Now, we just talked about some secondary and tertiary markets, but some of the larger markets that have actually seen positive rent growth in the last year, Phoenix, San Diego, and Oakland in California, Fort Worth. We are looking at Dallas, Fort Worth, that greater metro area. But Fort Worth is a market that's seen some positive rent growth. Miami, Orlando. Orlando's a market we're also always on the lookout for deals in. Fort Lauderdale, Columbus, Charlotte, and Virginia Beach. Charlotte in general, like the Carolinas, are a focus for us. So we're looking in Charlotte, Raleigh, Greensboro, some of those pockets, but Charlotte saw some positive rent growth. So basically, what does this all mean, right? We're seeing more, investors getting excited about investing. We're anticipating a sort of a shrinking of the bid ask spread, which is basically what the seller wants for the property and what a buyer is willing to pay for it. Over the past few years, we've seen some deals that were 20 to 30% off the asking price, right? When we kind of fully underwrite the deal. So internally, we've started to see that number compress. So that bid ask spread is starting to compress, which is a good thing. It means sellers are getting more realistic about the value of their property. So bottom line is going forward when we're looking at sort of market rent, we're not expecting 7 and 8% organic rent growth, right? We're working to get the property to market rent and then having moderate increases on an annual basis. So conservative underwriting is the name of the game right now. When it comes to debt structure, fixed rate debt only. If we do floating rate, it would be with a debt cap, a rate cap, I should say. But bottom line is we are focused on fixed rate debt with Fannie and Freddie. They're offering great terms right now, and we want deals that cash flow on day one that fit that agency lending buy box. In terms of operations, right, it's that 90-day NOI lift path. That's that 28-day transformation where we attack the property on day one, doing all the exterior renovations and amenities refresh as quickly as possible, showing value to the residents, installing exceptional property management that's on call and responsive, and making sure everything is just primed and ready so that when we start renovating units, we can capture that awesome post-renovated market rent that we're targeting in our pro forma. So if you found this episode interesting and would like to learn more, go to fulloutinvesting.com. That's fulloutinvesting.com. You can learn more about what we're doing here at Ferris Capital Partners and book in a time to connect with us if you'd like to discuss more about what we're up to, some of the deals we've done in the past, and the types of deals we're targeting going forward. We really appreciate you listening to the Multifamily Investor Playbook. If you found this content valuable, please share, like, and subscribe. And we love and believe in you. Have a wonderful day.